Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm here with my crew today, and I've got Dennis Bauer, Steve Farrar, Todd Miller, all formerly of NCUA and or credit unions and or credit union exam solutions. How you guys doing today?
Good.
Yeah.
Doing
Merry,
well.
Merry Christmas.
Merry Christmas. That's right. And because it's Christmas, near Christmas, we have a quarterly episode that we've been doing, and we're going to be talking about the quarterly credit union data summary that comes out from NCUA. Of course, this would be for quarter 3 as of September. But before we jump into that, just in case there's some new watchers or some new listeners, why don't you guys give a little bit of your background? And I'm gonna start with Dennis. We're on my screen. I've got Dennis, Steve, and Todd going counterclockwise. Dennis, state your name, your background, et cetera, et cetera, et cetera, for those new listeners.
I'll do that. I'll keep it quick too. So, yeah, I've been in the credit union industry I was in the credit union industry for about 38 years. My first 6 years I spent with the NCUA. I worked as a field examiner, and then my last couple years with NCUA, I was a problem case officer. Then I switched sides, if you will, and I spent the next 32 years at a credit union in St. Paul, Minnesota. I was Postal Credit Union, and when I left, our name was Ideal Credit Union. I came on pretty much in the finance operations area, so I've stayed with that credit union for 32 years. I retired in September of 2024, so just over a year ago, I retired, and I spent my time, as I said, in the finance and in the operations area. I finished up as the credit union's chief financial officer. So as I spent the 32 years there, we grew from a credit union of about 100 million to just over billion. And then Mark tapped me. I started out working with Mark, actually, with NCUA. We started as examiners together, and I stayed in touch with Mark throughout my career. And he asked me if I needed a little whiskey money, and so I jumped on, and I tried to bring an aspect a little bit of probably NCUA, but that knowledge is long gone after 32 years, but more from a credit union operation perspective. So that's my story.
That's your story. I remember when I had a Code 4, Code 5 credit union in my district that will remain nameless, who was trying to open a branch on the West Coast, and we were in the Midwest. And I think we even had a letter of understanding, the agreement that they agreed not to do it. And you said, well, let's pick up the phone and see if they opened one. And you called information, and sure as rain, the corridor.
I don't hear Mark Munchiel cars.
Yeah, Mark, why don't you talk to these guys? Yeah, so I'm not sure we ratcheted it up somehow, but they've since merged, but we won't mention who that was.
No, we won't.
Protect the guilty. All right, Steve Farr.
Hey, I'm Steve Farr. I break my career now down into the three parts. The first 15 years are in the field for the NCUA, and mostly as a problem case officer, which was self-rewarding work, I'd have to say, because you loved working with the credit union management and in fixing the problems and not having to necessarily merge them, although that happened sometimes. We had conservatorships and extremely bad cases. Spent a lot of time in Alaska at one point. Then after that, when Mark went to the central office, I followed him there and worked remotely for basically about the next 12 years or so in the division of risk management. And we all became Todd and I and Mark were deeply involved in the corporate resolution. Towards the end of my career, I was vice president of the CLF and spent the last couple of years working on the risk-based capital rule. Since leaving NCUA, enjoyed the consulting that we do. I got to do a stint as a chief financial officer at a conservatorship in Manhattan, which was, it's a great place to be when you're able to stay in the hotel and walk to work. That was a great experience. But yeah, I think we've enjoyed being able to keep our saws sharp with the consulting and keep up with what's going on in the industry. And now we're just sitting really observing, this influx of change that seems to be happening right now. So we're gonna enjoy the ride.
Yeah, that's for sure. Enjoying the ride. I like that. If I remember right, I'm going to get part of this story wrong. You came out and helped me when I was out on the East Coast, and you had to do something for us in New York City. And Somehow I'm picturing a David Cohn no-hitter that you either were able to go to or weren't able to go to. Which,
But I bought tickets to go to the game when I was doing the examination of one of your conservatorships, and nobody really showed me how to ride the subway to Yankee Stadium, and I was like, I don't think I'll take an adventure on my own. And so I was working out in the hotel gym and watching the no-hitter take place.
you could have kept those tickets and sold them now on eBay, get your money back. All right, Todd Miller, last but not least.
I spent 34 years with NCUA. I can kind of break my career down into three big chunks. First decade, 10, 11 years, I was an examiner, problem case officer on the West Coast. Then I spent roughly 11 years as a capital markets specialist on the West Coast. And then I spent about 12 years as the director of special actions on the West Coast, supervising problem case officers, capital market specialists, regional lending specialists. Steve mentioned the corporate thing. I have what I call my lost year in there. After the agency conserved Westcar, Mark drugged me in there, and attorney Bob Fenner would send us a letter about every 3 months, the same letter. We're not allowed to talk to anyone about what we're doing. I just didn't talk to any of my fellow peers or anything for a year. So I call it my lost year. I just went to Westcar every day.
That was
for a whole year.
That was an interesting time.
It was very much an interesting time, but I enjoyed my 34 years with NCUA. Like Steve said, there's times we did assistance packages. We gave credit unions capital to help them survive. A lot of them are still there. I don't know how many conservatorships I did, but I did return a couple conservatorships back to the members, and those credit unions are still there today. Those are quite rewarding. You learn a lot on a conservatorship because you get to be the board of directors and the CEO and everyone else, and got your hands tied, and you got board members wanting this from you and that from you, and you tend to learn a lot of operational things that examiners don't when you have a credit union conservatorship, and it's very rewarding to give those back to the members.
It is, yeah. I had a couple that we were able to spin back too. That we all enjoyed our time helping credit unions in that PCO role. We were all PCOs at one juncture, and it's a lot more fun being on this side of, at least at this stage of our life, a lot more fun being on this side of the table helping credit unions. But with that, let's pivot into the quarterly data for the September 2025. Which trend do we want to talk about first, and who wants to jump in? Todd?
I'm never scared to talk first. So, and it's not so much in trend. It's somewhat interesting if you look where credit unions went from like 2010 to COVID. We had really low rates, so things got distorted. Then COVID, we had this massive liquidity infusion and rapid growth and a lot of dumb investment decisions and long-term asset decisions made. Then we get inflation and rising rates, cause some credit unions to struggle. And kind of where we're at here in the last year is it's almost a return to normalcy. People are getting their net interest margins back where they're at. Balance sheets are getting in much better shape. You're almost seeing a return to what credit unions look like in, say, 2007, 2009. Your share structure is returning to normal. So all in all, this year, it's like a really good year for the industry as a whole. Capital numbers have come up. Growth is slow. Okay, there's some delinquency things happening at the edges. But in general, it's kind of returned to normalcy here for credit unions, which is kind of a good thing. In other words, it's not as exciting as it has been here the last few years when you look at these trends. Even the negative earners, there's only like 514 of them, or 630 of them last year. So, that's way down, and interest margins are looking nice. So I would call the whole trend is it's kind of a return to some normalcy. Even though NCUA is in turmoil, the credit unions are returning to kind of a normal operating stance.
Yeah, there's a little bit of turmoil going on at NCUA. We may or may not dive into that somewhere along this call. Dennis, Steve, any thoughts on what Todd had to say there?
Yeah, on the margin, it was good to see that, right? I think margins compared to a year ago, they were up approximately 30 basis points from September of 24 to September of this year. And that it's sort of predictable just because of what to some degree what's happening with the overall yield curve. Todd mentioned that things are getting back to normal. I think the yield curve is not quite, steep, the whole yield curve, but from the 2-year point on, it's fairly steep. And then the difference between the 3-month and 10-year and 2-year has shrunk, and mainly because, right, short-term rates have come down, which then has resulted in, cost of funds sort of stabilizing. They haven't really increased. They're probably starting to actually maybe start to decline a bit just because of the way the short-term nature of short-term CDs and non-maturity deposits. So I would assume credit unions are starting to reprice those down. Whereas then on the asset side, right, it's geared more towards the longer end. And that part of the curve is not actually, that's not coming down. I think the 10-year is actually up higher than it was a year ago. So that's good for maintaining higher yield on assets, earning assets. So as a result, you got a 30 basis point pickup in interest spread compared to a year ago. Well, and I will probably get into that a little bit more, but some of that was eaten up, right? When you take a look at the ROA overall, was only up 11 points. So we'll probably talk as to reasons why that's going on. But that's sort of what I would take on to the margin and things getting back to normal for credit unions.
Got it. Steve, any thoughts to highlight, add on to that theme?
Yeah, just, in big picture, one of the things I do each quarter is I compare the credit union's performance against community banks. And like Todd said, it's been a pretty good year in terms of performance. And it's that way with the community banks also. They come in with a significantly higher ROA. They're at 1.11%. So, they're quite substantially higher there. And they have the other really astonishing numbers. They're much, much lower in terms of loan losses. They're at like 0.19, and the credit union industry is at 0.77 or 81. So that's the biggest difference. And and then there's the funding of those losses that the credit unions are having to fund more in loan losses than community banks. But generally, the numbers moved in concert, where their net interest margins went up by so many basis points. It was really close to what the credit union industry did. So, like how Todd says, it looks like a good year. And then, like Todd talked about, where we're at in terms of unprofitable credit unions. You have the number there for the industry. It's 11.78%. But when you look at any of the credit unions over 100 million, it drops to 6%, which is pretty comparable to the community banks, in that they run like 5.26% of their institutions were unprofitable. So we're, the performance of credit union industry against community bank, pretty consistent.
I got to text a client back who wants to chat. Let them know that after I'm recording this podcast, I will give them a call. All right. Sorry about that. So the community banks numbers are similar but different. And Todd, you said something about delinquency around the edges. So capital's strong and getting a little bit better. But let's talk about the asset quality side of the game. What are you seeing statistically in the asset quality arena?
First off, let's just talk about the effect that our ones credit unions have on this. So they're 25% of assets in the country, but they have 37% of the delinquency and 42% of the charge-offs. So our 21 credit unions at once have a big impact on what the national numbers are showing for charge-offs. But when you look at things in aggregate, sometimes you break these delinquency and charge-offs numbers down. And I sit there and wonder why credit unions have credit card portfolios anymore, or unsecured debt. Charge-off ratios on credit card portfolios have been over 5% for 2 years now. That's a big number. You're seeing a deterioration in auto loans. And in fact, auto loans have been shrinking a little bit in terms of the portfolio that you see credit unions. And maybe this is in response to those loss rates. They're moving more and more towards more real estate loans again. And I think part of the lending and the auto lending shrinkage and slowdown, you have almost a 1% charge off in auto loans, not quite. 88 basis points, 1.1 for used cars. But part of that, I think it's just a matter of the economy is slowing. And I just bought a new car and there's a little bit of sticker shock. You can hit $50,000-$60,000 really fast on a not so fancy truck pickup anymore, or an SUV. And I think maybe you're seeing a slowdown on that just because of economic uncertainty. You're definitely seeing increased losses in those auto loan portfolios. Real estate and stuff is still looking really good, and maybe that's why credit unions are kind of moving in that direction. And commercial lending losses are pretty low, and maybe that's why you're seeing some growth in commercial lending the last 2-3 years too. But I know NCUA is extremely worried about those commercial loan portfolios and how are they going to hold up? And, that's always $1 million question. All 4 of us have been around for 3-4 different recessions, and those tend to be little geographically isolated things. This recession, it's in these 3 states, and this recession, the losses are kind of in these 4 or 5 states, and this recession at these states. And that's probably the way it will play out again next time, but trying to predict where those states are going to be, not so easy. So NCUA worries about everybody.
That's right. They worry about everybody, and they send out their warnings about everybody. On the delinquency and asset quality, Steve or Dennis, any additional thoughts on that?
One thing I saw, not so much in the data, macroeconomic stuff, unemployment starting to tick up. I think unemployment came out even today. I think it ticked up to 4.6%. But, they were talking about maybe because the participation rate is improved, so that might have an impact on that. But over the last year, we were well below 4. Unemployment rate is up to about 4.6% right now. And then median home sales, right? Those have declined over the last year or two. 2 years ago, the median house, I think, sold for about $435,000. That's down to $410,000. So that's approximately not a big drop, about a 6% drop. But right, so as I was leaving the credit union, we were getting all into CECL. So those potentially could have a little bit of an impact on your overall CECL calculation as you're looking, as you're looking forward and including macroeconomic things. So I noticed that. Then we did see that delinquencies increased. It hasn't really increased from a year ago, but from 2 years ago, it's increased, from 72 basis points up to 94 over the last 2 years. And charge-offs have increased from 55 basis points to 77. Then I looked at, okay, has the allowance changed? And that's actually compared to loans, that's improved from 1.2% up to 1.3%. So there's more dollars overall reserve. So let's say credit unions are taking that into consideration. But then I looked at another ratio, coverage ratio, which you look at, you take a look at your allowance compared to delinquency. 2 years ago, that was sitting at 167%. That's down to about 140%. So that hasn't kept up. And then I also look at net charge-offs to the prior year's delinquency, and that also has increased. So charging off more than we had in delinquency if you compare 2023 to 2025. So that may indicate, if that trend continues, that there might be a little bit more pressure for provision for loan loss to ensure that we're maintaining proper reserves in the allowance. So those are some of the things that I noted. Yeah.
As you broke that down kind of by loan type, because I kind of looked at some of that similar type of stuff, Dennis, and I looked at, okay, what are we provisioning versus what we're charging off? And at least through the last few years, there's still more provision than there has been charge-offs. Through this year, it's only 108% of PLL versus charge-offs. But if you go back to 2022, 2023, it was like 120, 130% of provision versus charge-offs. It has to do probably with loan growth too. I don't know, some of that numbers you're looking at changing just because the makeup of the loan portfolio is changing and leaning more towards real estate.
Yeah, I did break it down, and you're right. I mean, yeah, there's a move, as you said, into more real estate types of products, right, and more commercial. Right now, those aren't carrying maybe the same delinquency, so that could have an impact, obviously. Yeah.
played with lots of numbers and couldn't reach any conclusions. And, one reason Dennis looks at it, one reason I look at it, amongst our clients, and this has been going on for, multiple years now. And the larger you get, the more emphasis NCUA puts on it. They want justification for their concentration levels in their loan portfolios. They want you to model it. They want sensitivity around it. And I think that will probably continue in the future too, because we see it consistently amongst our various clients of all sizes. And it's been going on since we started in 2021, and it's still going on today in 2025.
Picking up a little momentum. Yeah. Steve, any thoughts on asset quality, delinquency? Anything to add to the commentary thus far?
Dennis covered it pretty good, because my analysis came out with kind of the one thing I was a little bit concerned about, the level of the allowance when you look at it in terms of metrics compared to delinquency and charge-off history. And Todd talked about that ratio of provision to net charge-off used to be around 130%. And that's what it runs in the community banking industry, and it hasn't changed over the last year. And credit unions are running significantly lower than that. So right now, the higher delinquency and higher provision expense is a competitive disadvantage that the credit unions do have against community banks. And we don't want that to become more of a disadvantage going forward.
Great point. So on asset quality, I was listening to a podcast, a fintech podcast, where this guy talks about different things, but he was talking to a guy who used to work at Capital One, and they were talking about the different risks that they see in lending, and they talked about where we're at today, and is there going to be a recession, and are there going to be problems tied to the unemployment rate going up, et cetera, et cetera. But the guy had an interesting comment of 2008, 2009, and back then there was this concept that people were more willing to turn in we're turning in the keys to our second home, or the delinquency was tied to a home situation, but people needed their cars to get to work, so that the car loans at the time were viewed almost safer than home loans in some instances. And his takeaway was, in 08 and 09, we didn't have Uber, so you couldn't get anywhere as easily as you can with Uber. And we also didn't have work from home. And then he got into this discussion about, the challenges in subprime lending. Subprime lending is higher than it was in 08 and 09. But his thesis, and it was just that, a thesis, was there might be more repos and problems at the white collar, higher level jobs, because they can Uber and they can stay at home and work in some instances, but they might, if something's going to give, it might be the car loan. And he was saying that even though subprime loans were a little bit more delinquent than normal, that it's the subprime borrowers who really need to have their vehicle to get to wherever they are going, because they tend to potentially be more in the service industry or the blue collar side of things. And any thoughts relative to that, or do you want to move on to the earnings arena?
That was interesting, because my last couple of years at the credit union, we saw a fairly significant increase of people just turning in their keys for their car. And Todd mentioned that. I think part of it too, right, is, I think what the guy said maybe makes sense in Minnesota here. I'm not sure, but car and truck prices are just so exorbitant. People just can't. After that inflation hit, then your bill. So we did see a more than usual number, and maybe that's continuing today, where people are just turning in their car or keys to their truck or car, more than I ever seen in my career.
It doesn't really break it down on the financial performance reports, but repossessed assets on credit unions' balance sheets are up quite a bit.
Interesting.
8% just in the last quarter.
Yeah.
So it's over $1 billion of repossessed assets sitting on credit unions' balance sheets right now.
And I wonder how many different ways they're being asked to account for that.
And there's more than what's on the balance sheet, because, examiners and CPAs, they'll let people, carry that as a delinquent loan rather than a repo if it's going to auction in a timely manner and things of that nature. So the accounting aren't exactly 100%.
our last exam, our examiner said you have to treat it as a repo, and you got to change your whole process. And so we went through that whole rigmarole, and our auditor said it was immaterial, but we still did it. Our lending folks did not like that. It was a pain. It's hard to do it on a core, right? There's a process you have to account for. So not a lot of credit unions do it that way, the right way.
I had, on a related note, I don't think I've mentioned this to any of you. I had a chat with a credit union that had been referred from someone who is familiar with the podcast, and it related to some challenges in the 5300 and how things were being reported. And they were looking at, we talked through some of that and looking potentially for some training on how to do that. But in the middle of it all, I said something like, well, I imagine that every time an examiner comes in, they might tell you that the way you're doing it now is wrong and you need to do it this way. And then the next one comes in. I said, I've seen that a lot in my last 5 years. It happens a lot more. And the CEO, who was on the call, kind of more of as an observer at the beginning of the conversation, came off mute and said, actually, that's exactly what happened in this. That's exactly why we're calling. How much can we push back on this? Can you provide us some training relative to this? And I basically said, work with your current examiner. NCUA's instructions are the instructions, and they interpret them a little bit different. Push back on where it says you have to do it this way. But I said, they felt better just knowing they weren't alone, that this was happening to them. But I digress.
Even I heard a lot of that from the Alaska credit unions back in the late 80s and early 90s. Tell us how you want to do it and quit changing it every quarter.
Quit changing it based on the right. And then they change the definition a little bit, right? But then they don't really explain, how it works. So then you get hundreds of examiners applying it slightly different with no real guidance from NCUA. And it's not ultimately the examiner's fault, because they tweak it without telling them. They walk in and then they have to do their best to explain. All right. So earnings, we touched on, Dennis, you talked about NIM being up a certain amount, but that the bottom line wasn't up that certain amount, that there's some difference. So we've kind of alluded to that, but
Yeah.
let's tiptoe into the earnings equations.
So we compare ROA from a year ago, it's up 11 basis points, but 30 basis points was positive because of the NIM, net interest margin. Non-interest income was down 4 basis points, so that took away 4. Provision for loan loss was about the same. I think it was up maybe a basis point. So you got total between those two of 5. So, but the big one then is non-interest expense. That was up 12 basis points compared to Q3 of 2024. And then I went back to 2023 and it was up about the same percentage. So it was up about 7%. Expenses were up about 7% in 2023 to 2024, and then another 7% from 2024 to 2025. So that is eating up almost half of the net interest margin for the last year.
So that's kind of interesting, because the expenses have been going up since COVID. It actually started, the non-interest expense started increasing during COVID. And supposedly, if you let people work from home, and a lot of credit unions do, I mean, we have a lot of clients where almost half of their back office staff are working from home. In theory, you should get more productive, but that's not the direction the credit union industry has went during this period. At a time when there's work from home and all of this, credit unions' operating expenses have gotten higher. Members per employee has stayed roughly the same. So you start asking yourself, why are their expenses growing? And maybe some of it's catch up in systems, implementation of CECL, more credit unions hitting the ones category and capital planning and models and things there. But some of it is just flat. We're paying people more. 2023, just 2 years ago, comp and benefits were $97,000. Here in September, we're up to $107,000. So almost, a 10% increase in 18 months, roughly.
Yeah, I think wage inflation, right? Inflation. I think inflation has a bit to do with it, right? We were up 20, I don't know how much inflation is up since 2022. It's probably 25, 26%, somewhere in there, right? So that's eventually got to leak into employee comp and ben. So I think that's a piece of it. But I broke down where the big categories. You got employee compensation benefits, that was up almost 8% over last year. office operations, that was up almost 8%. And then professional services, which that could be a myriad of things, that was up almost 10% from a year ago. So I think inflation, cybersecurity, technology, all that is contributing, trying to keep up is probably contributing to the overall expense structure growth.
That makes a lot of sense.
Yeah, we've heard from some of our clients in that they've been investing over the past 18 months or so in their technology to try and take advantages of AI. They expect to see that start to show in their numbers starting really next year. We'll see how that goes, because I was just listening to the guys talking about the implementation of AI, and some of the businesses that are really taking it on found that, they had to go back and hire people back because they needed a little more human touch than they were getting off of AI. So it's going to be interesting to see how that plays forward. And I think we're going to start seeing some of those changes pretty quickly, because I tried to look and see if I could see the change in the numbers yet, and I couldn't see anything that was an obvious reflection, and kind of confirmed by the analysis the other guys did.
So community bank expert Steve Farrar, what's going on with their operating expenses? Are you seeing that increase there too, or are they more successful at keeping it even?
It holds pretty steady there, and they do have a bit of a competitive advantage over the credit unions in that realm. It's like 40 basis points that they have an advantage over credit unions and operating expenses. Yeah, and you consider that they have the loss of revenue on taxes that comes into play too.
Interesting. So the last, if you couldn't tell, I kind of went through the CAMEL in order here as we were talking. Todd, on the front end, you talked a little bit about the liquidity side of things. Any general thoughts on what you're seeing in the liquidity type statistics?
You have a fairly balanced level of growth going on right now. And what you're seeing with the deposit base, it's stabilizing back to historic numbers. When we got to COVID, after those long years of flat interest rates, you had a mixture of people that were rate sensitive. All that money was everywhere. It was in money market, it was in checking, because there was really no differentiations on dividends from basically a savings account to a money market to a CD. Of course, as soon as rates started going up in 2023, 2022, you started seeing this rate sensitive money go to rate sensitive accounts. Right now, CDs and money markets are sitting at, let me look at this here, I have it somewhere, about 44%. If you look back 2007, 2008, when we had a normal yield curve, is right at 50%. So there's still a little bit of movement to go on, but basically our funding bases have gotten a lot more stable for our credit unions in the last year. This whole money moving from checking accounts into CDs or this disintermediation, it's slowed way down. So it allows them to improve that net interest margin because that funding base has gotten very stable. Loan and share growth were really balanced in the last year. There's only a percentage or two difference. So realistically, funding sources in our credit unions have stayed exactly the same. Wholesale funding, borrowed money, non-member deposits, it was 5.9% of liabilities at the end of December. It's 5.2 today. It was 8 in 2023. So, borrowed money kind of got paid down during 2024. And it's never going to go back to zero. That 5% is probably mostly people borrowing long-term to hedge interest rate risk. So liquidity trends look really good. I mean, we have clients that are still getting beat up over their liquidity, and NCUA has these expectations to support, how you operate with a limited amount of liquidity. But as the industry as a whole, they look in really good shape liquidity-wise. You've had balanced growth. The funding base has stayed really stable over the course of the year. So things have gotten a little bit easier for credit unions on that funding side. They still have to compete with all their other competitors that want that money, but they don't have this volatility in funding sources that was there a couple of years ago. So that's the thing for the industry.
You and I were on a call with the credit union within the last week, and they were getting asked to put some things that appeared to be on relative to restrictions on how or parameters or guardrails on how much they would put into certain member types, whether it was money markets or CDs or share drafts or. And,
They wanted the examiners of that trading, they wanted a limit on CDs and money markets to net worth. And, my response is, I think that's kind of BS. You have legal limits, and while it might be appropriate to put guardrails on non-member deposits and borrowed money, those secondary sources of income, I don't think it's reasonable to put guardrails on how you fund your share base between money market, CDs, regular shares. The marketplace and the yield curve is going to determine that for you, and competition is going to determine that for you. And, you can sort that out with your interest rate risk models and how you measure interest rate risk and other liquidity metrics. I basically said I see no reason at all why a credit union would say we're going to limit CDs to X percent of net worth. It made no sense to me where the examiners were coming from. And they didn't really justify it anywhere in their exam report either. Dennis is making a weird face. So,
Yeah, no, I was going to comment. I wish I was a CFO, I could do that. We're going to have, this makeup of our certificates. I mean, in a good example of that, how the market really determines it, rates really determine it. And Todd alluded to this, but back in 2022, before interest rates started to go up quickly, and interest rate environment was really low, there was only 14% of credit unions deposits were in CDs, right? Fast forward when interest rates started to increase and credit unions were trying to control cost of funds, and they're offering up short-term specials, right? That's now grown back up closer to 30%. So it's all a matter of asset liability management and the market that's going to dictate at a particular point where you're going to be. You got to model it all, and you got to make compensation for that. But yeah, putting a guardrail on CD portfolio, I wish.
So we advise them to push back gently, and hopefully they'll achieve some success in those negotiations with that examiner. Any other thoughts on the liquidity arena?
Well, just one other thing. It was obviously with the decline in interest rates, the unrealized gains and losses on investments is under 1%. It's at 0.79% as of 9/30. So that also, right, gives you a little bit more flexibility with maybe some liquidity issues you had before.
we will touch on this. I do have one more comment. So in 2022, when rates were low, a lot of credit unions went long-term on investments because they had earnings pressure in the flat yield curve. It ended up hurting them a lot, and they still haven't recovered from that. But what's interesting here this quarter is you can see the industry making bets on rates again, because they bumped up investments in that 3 to 5 and 5 to 10 year category. So there are some credit unions out there who are not making loans, but they are making bets on rates again, and hopefully it works out a little better for them than it did last time.
Interesting. Yeah.
I wonder when you do that, I wonder if credit unions are I mean, we always did that. We modeled, okay, we can hold it in cash, or we could pick a longer term investment, model it, and the risk that you take on for the little bit of gain in a rising interest rate, you could clearly see that it's not worth the risk. So it's just a matter of, okay, I got to make a decision how to deploy some of this capital, this cash. If you have a good AL model, it should pretty clearly show, you're not going to pick up a ton in a 300 plus rate environment. I mean, obviously it depends on the rest of your portfolio or your balance sheet. Generally speaking, not going to work out to your benefit.
That's why it looks like it's a pure rate. That they're just betting that the Fed's going to lower rates again, and they went long term with that this time.
Yeah, but then your gain, right? I mean, you're not getting much of a gain, even if it works out. I mean, your benefit's not going to be that great. Might add a basis point or two to your bottom line, but not worth the risk. Yeah.
When I hear risk reward, I think about this example, this quote I heard in there was a hedge fund that failed that was doing some risky things. They were called long-term capital management, but one of the people who ended up buying that, one hedge fund bought that hedge fund, and They said that their strategy was like picking up nickels in front of a bulldozer. Obviously, credit unions should avoid strategies of going along. Hopefully, if they're doing it, they've got people that are advising them on what makes sense, and they're not betting the house, so to speak.
Yeah, make a thoroughly researched good business decision.
And NCUA might ask for that documentation on that business decision. Who knows? So I have one slide in front of me from Aloya and did a presentation for Callahan on the quarterly data that they'd have. And of course, Callahan gets their data a little quicker and does a presentation on it. And one slide caught my eye, which the title of the slide is "Members are dipping into more of their available HELOC, home equity line of credit balances, and credit unions are issuing more lines." And the visual is this. So back in the end of 2020 through about the middle of 2021, credit unions had issued about 150 billion in lines, and those lines bottomed out on being tapped into at about 48% in the first quarter of 2022. So jump ahead to today, from the first quarter of 2022 to the third quarter of 2025, there, if I'm reading this right, about 325 billion outstanding. So more than doubled home equity lines approved, line of credits. And not only did they double, instead of being tapped into at 48%, they're tapped into at 56.4%. When I throw that out there, what pops into your heads?
Yeah, my experience with the HELOCs is it was highly regionalized, and that it's always in those areas with the highest increase in property values, and so I think it'd go beyond those numbers. I would be pretty sure that that trend would continue.
It really accelerated in 2022 and 2023, even 2024, but that has slowed way down here in 2025.
Okay.
I mean, it was double digits. So like I have it right in front of me, just outstanding balances went up 39% in 2022, 24% in 2023, 17% in 2024. It's only up 4% in 2025. So it's like, okay, if people tapped them out to the extent they're able,
Right.
and then you get certain things with the high cost of automobiles and stuff. How many people are using home equity loans to buy what would traditionally been consumer goods?
So yeah,
I mean,
so
the answer to that, but
you got, when we started, it was what, 36 and 48 month loans, and now we're into 60, 72, 84 or more loans, and then you could, because of the costs, you could spread it out. You could just pay, you get a home equity loan and just pay the interest, right? So that could be, or maybe you get the car loan and you put a little bit on the home equity line. So that could create some pressure points.
the other piece of it too is some of this could be just your remodeling and home improvement stuff as well. People, it's because of prices, it's harder to trade up, and there's less trading up going.
Yeah.
And there's less home sales available. There's probably ways to dig in and figure out what that money is being used for.
Well,
Could be a lot of different reasons. And maybe credit unions are doing it just to reduce their credit risk. And home equity loans probably a little bit less on that CECL model than a car loan is if people have that equity.
Interesting.
As long as home values stay where they're at. So when you brought that up, it sort of brought back memories of 2008, 9, and 10, right? That's where we experienced a lot of losses, were in the home equity portion of the portfolio. So, right, so increasing that and looking at that, hopefully good concentration risk limits in place, and following that, particularly, right, if values drop, making sure that you're covered.
That you're on it and you get reasonable limits. Makes sense.
I'm a belief that every generation has to relearn their lessons all over again.
What is it? So, I don't know who said this. History doesn't repeat itself, but it certainly does rhyme.
So
What else?
I think another interesting thing, NCUA they put out different pieces of information each quarter, and he has to go to their analysis page and download a whole bunch of different things. But, you know, on one of the things you can download, they have charts with CAMEL ratings. And while the number of code 3s isn't necessarily going up, the number of code 1s is plunging.
Really?
Yes, especially on credit unions 1 billion and over. The number of code 1s is just dropping every single year.
That's interesting. Yeah, I always focus in on the 3, 4, and 5 data, and I just kind of ignore that one. But that's interesting.
Code 3s went up in 2024. They haven't in 2025, but certainly the number of code 1s is tumbling in the 1 billion and 10 billion categories, which is kind of interesting when we know that supervision-wise NCUA is going to do less. They're extending exam cycles, and it will be interesting to see how that plays out. I see a not good ending to it personally, but
I had, you know, along the lines of NCUA extending the exam cycle, and as we've discussed on other podcasts, and Todd, you discovered that on their NSPM, they changed without publishing it, that they don't necessarily have to do a follow-up in a code 3 every 180 days. And you know, it used to be that they had to, and it had to be from finish date to finish date, and then they played with that a little bit. Well, now they're saying you don't necessarily have to have a follow-up. And of course, the CAMEL code in part is a resource tool. So if you code them a 3, but you don't have to go back, are you really using it at the resource tool that it's supposed to be? And I made I was chatting with somebody from NCUA, and I was saying, so what's the result of this going to be? Are examiners going to go in and say, hey, this is a borderline 2-3. I'm not going to have the resources to go in there. So you know what? I'm going to err on the side of not caution and give them an overall 2. Or are they going to put their thumb on the scale the other way and say, hey, you know what? I'm not going to have to go back, and I don't want this to blow up on my watch, so I might as well code them a 3 anyway, because I'm not hamstrung by having to go back. Which one will it be, or will it just normalize out, and you'll have some doing one and some doing another? But there will be some ramifications of this resource issue on CAMEL codes one way or another.
the ones they put the thumb on the scale are the ones that are calling us.
Yes. Oh, yes. Most definitely. Most definitely. So, and that conversation was around that is what is it that we're seeing? And we see a little bit of that where there seems to be an overly aggressive situation in a particular credit union. And hey, if you're listening and that happens to you, give us a call and we can help out.
The other part of it, and maybe I'm just overthinking it, you're going to have a change in administration in a couple of years. They're going through all these massive cuts now. And, you know, this kind of happened during the Reagan years with NCUA as well. By coding them lower, they setting a stage for, you know, in 2029, 2030, okay, we need to hire all these many people back. I don't know, like I said, I might be overthinking that. As a supervisor, I might actually have thought long-term like that. You know, how do we get out of the turmoil when there's a change in administration?
Sure. Well, a change in administration, and at some juncture, you know, if they reduce costs in the budget, $100 million, picking a number, and there's less of a imprint in credit unions, short-term individual credit unions like that, at some juncture, the economy moves. There is a loss or two. The IG does an audit report, brings that audit report to management, and says, we have to come out on agreement on how to fix this. And you, at that point in time, you have an NCUA board that has the appetite to expand staff. That's how I see it playing out, and the pendulum going in the other direction. And it probably ties to obviously a different administration at that juncture.
All right. One other thing that I usually update every quarter is I take a quick look at the NCUSIF, carrying it to the deposit insurance fund. And they both had a pretty good quarter, but equity ratios or the designated reserve ratios are up. You know, the equity ratio of the NCUSIF is 1.28 with the normal operating level 1.33. But the deposit insurance fund had a tremendous quarter. They finished a restoration plan when they got up above 1.36. theirs is at 1.40 now, so they're doing really well with their long-term goal of getting to 2% because of how massive their losses can be because of contagion risk and all that. One of the more interesting things is the yield on investments is so different between the two. For the NCUSIF, it's 2.77% with a weighted average maturity of 2.7 years. The deposit insurance fund is yield on investments is 4.2% with a weighted average maturity of 0.57 years. So they garner a lot more off of their investments.
But they stayed short. So is that, so their maturity is 0.57, you said?
Yeah.
So they're shorter, but a higher yield than it's okay.
Benefiting from that inverted yield curve, it'll
Yeah.
cost when wait.
Okay. That sounds like a Chip Filson email to the NCUA board. Yeah. All right, guys, so what else we got? Any final thoughts? Let's go around the horn here, as they say.
I started with, hey, things are returning to normal, and that's kind of where I'll end it too, is kind of where we're returning to a normalized level, which makes life a little bit easier for the credit unions. They still have all these competitive factors, and competition is never going to go away, and their job is not going to become easy, but it's a little bit easier for the moment.
A little bit easier. I like that. Steve?
Competition is continues to change and you become more and more real with other entities in which they have to deal with and the demographics. So I think it's something that might be affecting while there are less CAMEL ones.
Makes sense. As you mentioned, demographics, 2 episodes back, had a really good episode with Dan Prezioso of Olden Lane about the dynamics of the different age groups, the Gen X, the Gen Z, the Gen Y, the Gen Q, whatever name they put on all the generations, and how that's impacting credit unions, and having a game plan for that. If you've made it to the end of this episode, and you haven't listened to that episode, I highly recommend it. Dennis, all right, last thoughts.
Yeah, I basically what Todd said, and credit unions are getting back to normal. The only thing I'd point out, again, credit unions continue to grow. They're strong. However, the number of credit unions continues to drop. I think since the last quarter, we're down 168. And any credit unions under 100 million lost 179 credit unions. So obviously a shift, and then mergers accounted for obviously that change.
And then there's the whole arena of the big merging with the big, which we won't get in here today, but some interesting big approvals across the industry, which will impact the landscape as well. All right, guys. And thank you, as always, for being on the show. And listeners, I want to thank you for listening, and or watchers on YouTube. I want to thank you for watching. This is Mark Treichel signing off with flying colors.